if it is vacant, if there is no tenant in that particular house, so you will not be receiving the rent, right? So for that 3 months, we will not be considering. Self-occupied property, we will not be considering the gross annual value and municipal tax paid because we are not receiving rent itself to compute the gross annual value. So interest is given for house 1, for house 2 the interest is nil. So the total loss from self-occupied property is 1,41,600. Hello everyone, I am Arun Kumar, lecturer in Department of Commerce and Management, Vidhyaashram First Grade College, the Temple of Excellence, Mysuru. Dear students, welcome to this new session on Unit 3, Session 2. The topic is income from house property. Yes, dear students, in the last session we discussed about what is the meaning of house property and what are the types of house property we have. And we also discussed what is fair rent, what is standard rent, and how to compute gross annual value. And we also solved a few problems in the previous session. So in this session, we'll continue solving the problems with respect to income from house property. So next problem, Mr. K.K. Bansal owns a house property in Pune. Mr. Bansal owns a house property in Pune, which is let out for 8,000 rupees per month. So every month he is receiving rent of 8,000 rupees and its municipal valuation is rupees 80,000 and Dr. Bansal paid municipal taxes of 5,000 rupees. Yes, he is receiving 8,000 rupees rent per month. So if he is receiving for 12 months, so what is the total value comes for 12 months? So 8,000 rupees per month into 12 months, you'll get nearly 96,000. Right? So you'll be receiving 96,000 rupees of rent every year. Okay. So municipal valuation 80,000 and municipal tax paid is rupees 5,000. So other expenses relating to the property are following. So repair and insurance premium rupees 7,000. Interest for purchase of house rupees 42,000 and the house was vacant for 3 months in the year. And compute income from house property for the assessment year 22-23. So here repair and insurance charges is given. How much? 7,000. See, except 30% of annual value and interest on loan. Except 30% of annual value and interest on loan. That too, the loan should be taken for the purpose of construction of house or repair of house. Only those two expenditures can be deducted from the annual value, not any other expenditures. In the problem, he'll give different expenditures like repair charges he'll give, insurance premium he'll give, collection charges he'll give, and other expenses like painting charges he'll give. Okay, he'll give different expenditures, but we will not be considering any expenditures except the standard deduction of 30% of annual value and interest on loan. Okay, so now here the house is let out for 8,000 rupees per month and it is vacant for 3 months. That means 3 months there was no tenant. Okay, only it is let out for 9 months. For the remaining 3 months, no tenant. So now what is the total rent received in that particular year? So 8,000 per month into 9 months. Right? It's 9 months. So totally how much? 72,000. So if you would have received rent for 12 months, then the total rent for the year will be 96. But you received rent for 9 months because it is vacant for 3 months. So now what is the rent received? Actual rent, it is 72,000. So now let us solve the problem. So computation of income from house property for the assessment year 22-23. So actual rent for 9 months. Yes, we are considering the actual rent for 9 months. Because it is vacant for 3 months. If it is vacant, if there is no tenant in that particular house, so you will not be receiving the rent, right? So for that 3 months, we will not be considering. Okay, so 9 months, you will get 72,000. How you will get 72,000? So 9 months into 8,000 per month, you will get 72,000. And here 80,000 rupees of expected rent that is given in the problem, which is called as municipal value. See, in the problem you can see municipal value is given rupees 80,000. So 72,000 and 80,000, whichever is less. So if you consider the less value, you'll get 72,000. The 72,000 is going to be the gross annual value. So from gross annual value, less municipal tax paid, of rupees 5,000. Yes, 5,000 rupees is given in the problem. Municipal tax paid is how much? 5,000. So 5,000 less 5,000, balance 67,000. So from 67,000, this 67,000 is called annual value. 67 is called annual value. Next, less standard deduction. Less standard deduction of 30% of annual value. This 30% is always fixed. 30% of annual value is always fixed. So less 30% of annual value. So if you compute 30% on 67,000, you will get 21,100. And also interest on loan is given. What is the interest on loan? 42,000 is given in the problem. Interest on loan 42,000. So deduct interest on loan. So deduct 21,100 and 42,000. You will get the total of 62,100. How much? 62,100. So now deduct the 62,100 from rupees 67,000. From rupees 67,000, you will get the balance of 4,900. You will get the balance of 4,900. That 4,900 is called income from house property. So first we are supposed to take the actual rent and the expected rent, and whatever the rent received is going to be the gross annual value. So from gross annual value less municipal tax of rupees 5,000, you'll get the balance. That balance 67 is called annual value. From annual value less 30% of annual value, less 30% of annual value, that is 21,100, and also less interest on loan. Interest on loan of rupees 42,000. Totally less 62,100 from 67,000. You'll get balance of 4,900. That 4,900 is going to be your income from house property. So this is how you are supposed to solve the problem. So moving on to the next problem. Okay, in this particular problem we have two houses, house 1 and house 2. So Mr. Arish owns two houses. The particulars of the two houses for the previous year 2019-20 are given below. Okay, so two houses. Use of house. House 1 is self-occupied, house 2 is let out. House 1 is self-occupied, that means it is occupied by the owner, that is by Mr. Arish. And the second one is let out. It is let out for rent. Next, municipal valuation, how much? 30,000, 60,000. Fair rent is given 35,000, 90,000. Rent received is how much? 1,20,000. Standard rent 25, 65,000. And here municipal taxes paid 4,000, 8,000. Interest on loan for construction of house 3,000 and 40,000. Okay, interest on loan 3,000 and 40,000. Compute income from house property. So here all the four informations are given. Municipal value is given, fair rent is given, rent received is given, standard rent is given. So first we solve with self-occupied property, that is house 1. Okay, house 1. So self-occupied property, house 1. So in self-occupied property, we will not be considering the gross annual value and municipal tax paid, because we are not receiving rent itself to compute the gross annual value, right? We are not receiving the rent to compute the gross annual value because it is a self-occupied property. So directly we will take self-occupied house, house 1 self-occupied. Directly we will take annual value. Annual value will be nil because we are not receiving any rent. So annual value will be nil. Less interest. Yes, interest is going to be a expenditure for him. So less loss for him. So less interest of rupees 30,000, and you will get minus 30,000 here. So this minus 30,000 is loss. So loss from house 1 or loss from self-occupied property. Okay, loss from self-occupied property. So what is the total loss from self-occupied property now? It is rupees 30,000. So whatever the interest you are going to pay on the loan, that interest amount is going to be a loss under self-occupied property, and the format is just annual value less interest. Whatever the interest you are going to pay for self-occupied property, that interest is going to be loss for you. So loss from self-occupied property. You can set off this loss under let out property income. So now house 2, it is let out property, that is house 2, let out property. So all the informations are given, all the 4 informations are given. So municipal value is given, right? So municipal value and fair rent, municipal value and fair rent, in this 2, whichever is high, whichever is high, municipal value and fair rent, whichever is high, you will get the higher value of 90,000. Okay, so 90,000 is the highest value. Now compare this higher value, that is 90,000, with standard rent, with standard rent. So in these 2, whichever is low, whichever is low. So 90,000 and 65, whichever is the lower value? Yes, obviously 65,000. So now compare the 65,000 with actual rent of 1,20,000. So in these 2, whichever is high, whichever is high. So high, low, high. If all the 4 informations are given in the problem, like the municipal value, fair rent, standard rent and actual rent, if all these 4 informations are given in the problem, then you are supposed to follow these steps: high, low, high. Fair rent and municipal value, whichever is high, whatever the higher value you will get, compare it with standard rent, whichever is low. In that, whichever is low, compare that lower value with the actual rent, whichever is high. So higher value is 1,20,000. This 1,20,000 is going to call as gross annual value. The 1,20,000 is called GAV, that is gross annual value. So from gross annual value less municipal tax paid, from gross annual value less municipal tax paid of rupees 8,000. Okay, less municipal tax paid of rupees 8,000, you will get balance of 1,12,000 rupees. Balance of 1,12,000 rupees. So this 1,12,000 is called what? Annual value. Annual value. So less 30% of annual value. Less 30% of annual value. So compute 30% on this 1,12,000. You will get 33,600. You will get 33,600. So interest. Yes, interest is also given how much? 40,000. So total this 40 plus 33,600. 40 plus 33,600. Totally 73,600. So deduct this 73,600 from 1,12,000. Deduct 73,600 from 1,12,000. You will get the balance of 38,400. 38,400. That 38,400 is called income from let out property. Let out property, that is house 2. So set off the loss of house 1, that is 30,000 rupees against this 38,400. I have profit of 38,400. Okay, I have profit of 38,400 and I have loss of 30,000. I have loss of 30,000. So set off this loss from profit. You will get balance of 8,400. This 8,400 is called what? Income from house property. Income from house property. So set off the loss of self-occupied property against the profit of let out property. You will get balance of 8,400. 8,400 is called what? Income from house property. Here you can see income from house property is how much? 8,400. So this is how you are supposed to solve the problem if all the informations are given. Yes, next moving on to the next problem. Problem number 5. Kumar uses 2 houses for his residential purpose. The following related to this. Yes, here the owner, Mr. Kumar, using both the houses, house 1 and house 2 for his residential purpose. That means both the houses are self-occupied. Both the houses are self-occupied. So what is this self-occupied? Self-occupied is nothing but the house occupied by the real owner of the house. House occupied by the owner, that is called self-occupied property. If both the houses, if house 1 and house 2 is occupied by the owner, then both will be considered as self-occupied only. Okay, both the houses are considered as self-occupied properties. So here you can see municipal value is given, fair rent is given, standard rent is given, municipal tax is given. Whatever is going to give, nothing is useful to compute the house property income, because under self-occupied property, we will not be considering any of these informations, right? We will not be considering any of the informations. Just we will be taking only the interest on loan, right? So we will be considering interest on loan to compute the problem under self-occupied property. So whatever the informations are given here, it's not so useful to compute the income from house property under self-occupied property. And one more thing you have to understand that under house property, the assessee can claim any two houses as self-occupied property, and for those two houses it is exempted. The exemption is given for the assessee to claim any two houses as self-occupied property. So here both the houses are self-occupied. Now we'll solve the problem. Computation of income from house property. So house 1 self-occupied, right? Annual value, yes, always it will be nil. Always it will be nil. Interest on loan, okay? Interest on loan is given. Yes, interest on loan, how much? 1,41,600. Interest on loan is given 1,41,600. So directly take the interest on loan. Interest on loan. So 1,41,600. So loan amount you can claim up to 2 lakh rupees, not more than 2 lakh. Here is claiming 1,41,600. You can claim 1,41,600 because it is less than 2 lakh rupees. Okay. So interest 1,41,000. House 1 finished. So loss from house 1. Next, house 2. House 2 is also self-occupied. Annual value is nil. And interest, obviously interest is not given for house 2. You can see here, interest is not given. Interest is given only for house 1, not for house 2. So interest is not given, nil. So now 1,41,600 is going to be the loss from self-occupied property for Mr. Kumar. So what is the total loss? The total loss is 1,41,600. So loss from self-occupied property. Self-occupied property. So assessee can occupy the two houses as self-occupied, and in self-occupied always we start with the annual value, and annual value is going to be nil. If interest is given, interest on loan is given, that amount we consider and we are going to call it as loss. Loss from self-occupied property. So interest is given for house 1, for house 2 the interest is nil. So the total loss from self-occupied property is 1,41,600. So this is how you are supposed to solve the problem. So with this, I am going to wind up this session. We will meet in the upcoming sessions. Until then, thank you all. Have a nice day. Namaste.